Hey, welcome back. Getting to episode 17 of the stocks you recommended with 4 high potential companies traded at very different valuations. Don't forget to check out the other videos in the series and leave a like to support the channel and help me get to 100 companies by the end of the year. Now, Grab, this is a South Asian company providing ride-hailing and food delivery services similar to Uber as well as financial services. The stock crashed a lot from the IPO even though it's up a bit recently. This is basically the Uber of South Asia plus the financial services, and in many of these countries you don't get an Uber, you get a Grab. The idea behind the investment is very simple: tourism, growing population and growing economies. They got to around 41 million monthly transacting users, meaning about a 17% increase year over year. The net income is negative due to stock-based compensation, but they recently had a positive cash flow, although this is where banks in general can get a bit tricky. Because if you look at the deposits from customers, that would be a positive change in working capital, but that's not their money to spend. Thankfully they adjust it and it's easy to see that it's still positive, but be careful especially with banks and fintech. We don't really know how much they can reliably make, so it can be a bit tough to value them properly right now. Comparing them to Lyft, they make about half the revenue but are valued at like 2.5 times the market cap. Comparing them to Uber, again pretty expensive, but these companies don't have the financial services, so there is a limit to how much you can rely on these comparisons. Comparing them to SoFi, kind of fair, but again not the same business and a completely different region, market share, brand and so on. Financially, they are in an excellent position with just the cash alone, not even the total current assets, covering the total liabilities. There isn't a ton of equity, but this is not an equity-heavy kind of industry, and what they have is actually quite a bit for this market cap. They can continue to lose money while they develop for at least a few years before having issues, but again, they are getting into the positive, so this balance sheet is a huge advantage. Not to mention that they can get into debt and develop in other countries, which can really unlock a lot of growth. This is very similar to Lyft, which also started turning into the positive recently, so there is potential. But Lyft is in the US, while Grab focuses on Southeast Asia, which has the advantage of a growing population and a lot of tourism, which is very important. Uber would be the global leader, but if you want specific exposure, you have Didi in China, Lyft, Grab and a few more. In the region, Grab is actually the dominant player. But something different about them is that they are becoming kind of an everything app because they also offer financial services on top of the mobility that all the others do. We see significant growth in loans and even more than 50% growth quarter over quarter in deposits. So they can benefit a lot from the global economy recovering, the potential for tourism and even local transactions. This can also be great for the fintech side of the business and would allow the company to get some cheap debt and develop into other countries or expand their offering. So the potential, if you think about it, could be even better than what Lyft or Uber can do, so that can justify the valuation. By the way, I like Lyft and I looked into them in a previous video, so make sure to check them out as well. As a parenthesis, here is what I mean when I talk about a potential recovery. This is the number of tourist arrivals in Southeast Asia, meaning a majority of the countries they focus on. Compared to 2022, this can easily triple in just a couple of years. And the contribution of travel and tourism to the GDP of these countries is expected to more than double in a decade. Especially in these countries where you have a lot of things to visit in several places, ride-hailing or renting is pretty much mandatory. So there is definitely medium and long-term potential. I see this as a very healthy way to get exposure to the region at an okay price. If they prove that they can make more money, this has potential to be a multi-bagger. Now, rate cuts, economic growth, tourism revival and all those things should be very beneficial trends. But keep in mind that this would be affected in a recession, but at the same time, the time after it can be very good. So it's actually a cyclical company, and I'd say for me this has potential to be a good time to get into it. I'll add it to my watch list and will keep an eye on them while I do more research. Now, Krispy Kreme, this is a donut and coffee shop chain and also distributor. They are close to all-time lows, but the stock didn't really move that much since the IPO in 2021, which is pretty rare for the SPACs and IPOs during that time. By the way, do you remember the guy that was promoting those SPACs during the pandemic? Well, a significant majority of them are down like 90%, but his company got close to $1 billion in fees and commission. He even said that his goal was to promote as many companies going public as possible. Now, why are you allowed to openly promote, aka pump, a stock and influence the market? I don't know. But don't worry, him and Katie Wood and all the media that gave them a platform are okay. Anyway, the company is expanding in the US and also internationally. They have both their own restaurants as well as distribution agreements with McDonald's, Walmart and other retailers, which have a lot of potential. Overall, it's a decently powerful brand that grew quite a bit lately and has a lot of partnerships with big names. They talk about this profitable US expansion, but yes, it's an expansion, but they are far from profitable, and that's unfortunately not the main issue. The thing is, there are so many fast food chains out there that this must have a low margin. Sure, coffee and donuts are a bit more unique than pizza or burgers, but still a very competitive market that others can adapt if profitable enough. I mean, they never made a profit, but McDonald's, who's like the ultimate fast food chain when it comes to profits, is at like 25%, which is exceptional. Having anything close to this is realistically almost impossible, especially as a small company. They basically almost perfected the business up to every cent in every aspect, from real estate to suppliers, portions and so on. So Krispy Kreme, I don't know, maybe an okay assumption would be something like 10%. For a 1.7 billion revenue, that's 170 million in profit, placing them at a price to earnings ratio of around 12, which isn't terrible. The thing is, they have to get to that 10%. If they do it, then sure, they can get to the 20-30x ratios that we see in the industry, but it may not be that easy. They can focus more on the distribution side of the business, which is cheaper and doesn't require some big investment, but the margin on that is probably smaller. They expect about a 12x increase in the number of McDonald's stores that sell their products and overall estimate 33,000 points of access in 2026 from 14,000 a year ago. Now, what do they base this on and what's reliable data and what's empty promises? No idea, but be careful with this kind of estimates because they wouldn't be the first to overpromise and underdeliver. Revenue growth is simple when you lose money, but sustainable or profitable revenue growth is very different. Even the EBITDA margin is extremely small now, something like 12.5% after it grew a bit recently. We see them decreasing significantly on an operating cash flow level, and the cash flow is more and more negative due to higher capex on top. So yes, they are investing, but they are also making less money on more revenue. Another important aspect is the financial health. This is quite a huge issue because the current assets are like a quarter of the current liabilities and they also have a lot of long-term debt. They have assets on paper, but if you look at it, they have $1 billion in goodwill and another one in intangibles. What they actually own is $500 million in property. And the thing is, that's basically the core of the company, you know, all the machinery and stuff that they use to make money. They can't use that plus like 170 million in current assets to pay more than double that much. Either they issue more debt or issue a lot of shares, none of which would be good. So you see 1.2 billion in equity, but in reality it's actually negative and the company might be in trouble. Again, goodwill isn't an asset you can sell, it's basically an accounting adjustment for what the company overpaid in the past. So until they become profitable, they are losing more and more money and have significant debt that they can't really pay now, which can lead to really big issues. And even if they turn profitable, they would need a lot of money to pay back the debt. This can take half a decade or even more just to bring it to an okay state, so it's not that simple. That's half a decade of full focus on paying back the debt, no dividends, no buybacks, nothing. This is simply a no for me. I don't see anything that attractive that's based on something that's not promises. If they don't somehow turn it profitable in a couple of years, it would be a very tough position to be in. Even if they deliver on their promises and make a profit, the risk is too high right now for a 2-3x potential. There is potential, yes, but you have to be aware that even if they grow so much, if they don't make it profitable, the problems can rapidly pile up. There could be potential to maybe see some McDonald's, Walmart or similar company buy them to cut the cost, so they definitely have some upside potential, there is no doubt. It's all about the risk you are willing to take, but I think there are better investments for this level of risk, like Celsius, UiPath, Lyft and so on. In the whole series, this is actually one of the few companies that have a relatively high risk of bankruptcy, so be very careful. Now, Intuitive Surgical, this is an interesting one because they are a leader in minimally invasive and robotic-assisted surgery tech. As you can tell from the stock, the market is very hyped around the AI part of this company. We see pretty much a 2x in revenue and net income since 2020, and the company ramped up the capex a lot lately. The cash flow is still positive, but it's under $1 billion for a close to $200 billion market cap, so that's really not cheap. The market is clearly focusing on the company's potential to grow, but it would have to really explode to meet its expectations. With rate cuts potentially unlocking some delayed investments and a clear advancement in this direction in the future, they could see another cycle of growth, especially now that they increased the capex. The new Da Vinci robot is planned for a 2025 release, which I'd say is a pretty good timing from an economic point of view. This company obviously should have a ton of long-term potential, and it wouldn't be impossible to see this level of growth continue for ages. This is still a relatively young industry, so adoption is far from maturity. Financially, this is in an excellent position, with the cash alone covering all the liabilities. They don't really have debt, so there is nothing to worry about from this point of view. Something very important to notice in this balance sheet is the increase in property, plant, equipment and long-term investments. In not even a year, they almost doubled, which can result in similar increases in profit and cash flow in the future. But you get 15.6 billion in equity on a close to 200 billion market cap, so this isn't cheap from any point of view. Even when you take into account the growth and potential, which is the main thing you value such a company on, this might be far from a fair value. So if you look at the underlying business today, it's much smaller than what you pay. I've seen better balance sheets and profits valued at like a fifth of this, so is the potential to grow worth it? But again, a very healthy balance sheet at least, that can allow them to get into debt if needed, but I think there is something better they can do. I think the smartest thing to do now would be issuing stocks to develop. Because organically, if they invested, let's say, all the maximum potential cash flow, that's like 1% of the market cap, so it would do nothing. But external capital, that's literally free money, can really add up to quite a lot if they do 3-4% dilution per year for, let's say, half a decade. If not, they risk wasting an amazing opportunity because the second the growth isn't there, the market is out. We've seen this happen over and over even this year, and it shouldn't be a surprise to see this crash 20-30% in a day if they have issues. Again, it's a matter of balancing the risk and reward, which I think is very similar to ASML. I think this is something that the market would buy, especially for the technological competitive advantage. Can they keep growing? Sure, get a government contract in Europe, a deal with a big chain in the US, and that's some other billions in revenue. But the same as ASML, which is the leader and actually the only company in the market that does what they do, you have to think about how much you pay for it. This is a close to 200 billion company that makes like 2 billion per year. You know, if they, let's say, 4x the net income, then this price would be okay. Anything above that at this price, that's potential to grow. However, any issue or slowdown or whatever, the same as we've seen with ASML, means 10, 20, 30% crashes. Have 3-4 bad quarters in a row and this can easily be back to like 2020 prices. The company itself, sure, is amazing from a financial health, margins, growth, potential and so on point of view, but you have to be careful how much you pay for it. This is a very fragile valuation, and even if they can continue to grow, we've seen what delivering, for example, 80% growth when the market expects 100 can do to the stock with Pinduoduo. Any sign of a weakening market or the slightest issue or slowdown or competitive pressure can wipe out years of growth from the stock. So very good company, but definitely not a good risk-reward potential at this price. Now Airbnb, I'm sure all of you know them. They aren't the number one travel platform that would be booking probably, but if you are looking for an apartment or something a bit less organized than a hotel and stuff, this would be the number one option. The stock didn't really go anywhere since the IPO, although it had some moments where this would have been 20, 30, 40% cheaper. However, the company itself improved quite a bit, with the cash flow, revenue and profit jumping significantly. This would make sense if they issued stocks at the same rate, but they barely issued like 6% since the IPO. They even bought back a tiny bit during that period to account for the stock-based compensation. What it means is the market either had very high expectations, as it normally does when they went public, or they are much lower now. Anyway, what's certain is that we have a company that can now make over $1 billion per quarter with a 41% cash flow margin, traded at around 80-90 billion. That's a ratio of around 20 for a company that should benefit a lot from a cut in interest rates. This should have a positive effect on travel, so they can continue to grow and develop the business. We can see overall solid growth rates and margins in revenue, EBITDA and profit as well. They keep innovating and developing the platform, deepening their already significant competitive advantage. Financially, they are in a very good position, with the current assets covering all the liabilities. Since they are a digital business, they don't really have any other assets on the balance sheet, but things like the app, the site and the overall value of the brand aren't there, so the real balance sheet is much better. Just a parenthesis, we rely on accounting rules made by people who lived and died well before the internet and PCs. You know, a majority of the current accounting principles are the same as when they were done with a pen and paper. It's okay to some degree for a factory or a mining company, but it becomes less and less useful and doesn't tell you that much with such a company. They are advancing and changing, but all the digital stuff seems very much left behind. An advantage is the company's popularity and experience. It's normal at this point to call the apartments used for short-term renting Airbnbs, even if you don't rent them on Airbnb. When you say an Airbnb, a majority of people know what you mean. This is like the ultimate level of brand popularity from a marketing point of view. The problem, I guess, is that it got quite expensive lately and people may just use other apps. But they have the huge popularity that will probably keep them relevant for many years no matter what they do, but there is risk of competition. So if they mismanage it and downplay the risk, this can be a bad long-term investment. Plus, there can be political issues because owning an apartment just to rent it on Airbnb can have very negative effects on the local population. Look at Spain, I think it was in Barcelona or Madrid, where people protested because you just can't afford the house anymore. You know, same as with stocks, when the dividend yield, in this case the rent, jumps from the 4-5% that you could get from real estate to 15-25% thanks to renting on Airbnb, asset prices also follow. Sure, not overnight, but if you leave it unchecked for some years, that can lead to the current issues. I think Germany already has some law regarding something like this, and more countries will eventually follow. This can either affect Airbnb directly or indirectly by lowering the offering, increasing the prices and so on. This can be a bit tricky because you have to balance the business aspect of renting and tourism with the quality of life of the people that vote for you. So this can see some significant swings based on left or right-leaning parties in power at the time. This can mean uncertainty, which the market really doesn't like. But it can also open some opportunities because it would affect all the players, not only Airbnb. So overall, I don't really see that many negatives, and the company is developing even in not such a friendly environment. Great financials, very good cash flow margin, growing and with potential ahead. I think it's a very clear way to get exposure to the travel industry with a good and solid company. This might be one of the pandemic IPOs that's now becoming a real business, while the market doesn't pay that much attention anymore because it's chasing all the AI hype and higher growth. Still, at around 20x the cash flow and with the potential from rate cuts, this should at least be a fair value in my opinion. I wouldn't call it cheap, but it had some drops that could have been attractive over the past year. So, 4 interesting companies that show very different feelings from the market. Talk about AI and you trade at all-time highs, while the companies that also developed significantly lately are at some of the lowest points ever. I'd say all but Krispy Kreme are actually good companies from pretty much any point of view, but it's a matter of how much you pay for it. Don't forget that businesses are ultimately an instrument that makes money, no matter what they do. Anyway, don't forget to leave a like and check out the other videos in the series. As always, what I cover in my videos shouldn't be enough for you to make any investment decision, so please do your own research before investing in anything. If you want to see more videos like this one, please leave a like and even a comment to help me out, and make sure to subscribe. Thank you for watching, and I'll see you next time.